At 8:43 a.m. in Ottawa, three phones began vibrating almost simultaneously inside the Privy Council office. By 8:47, senior trade advisors were no longer speaking in complete sentences. A deputy minister quietly removed his glasses, closed a red briefing folder halfway through a presentation, and stared toward the television mounted above the room. On the screen, reporters outside the White House were repeating the same sentence again and again. The United States wanted the trade war over. Quietly, no formal ceremony, no victory announcement, no presidential celebration, just a sudden shift in tone behind closed doors after 11 months of escalating tariffs, retaliatory restrictions, diplomatic friction, and mounting market pressure that had begun spreading far beyond North America. But inside Ottawa, almost nobody reacted with relief. Because Canadian officials understood something Washington had failed to anticipate. The request itself revealed weakness. And in geopolitical negotiations, timing is rarely accidental. Within minutes, encrypted messages were moving between Ottawa, Toronto, London, and Brussels. Market strategists inside New York investment firms began circulating private notes to sovereign clients. Currency traders noticed unusual positioning in Canadian dollar options before North American markets even fully opened. One analyst at a major European bank wrote a single sentence to institutional investors before dawn trading began in Frankfurt. Canada appears prepared to extend the standoff. That was the moment officials realized the crisis was becoming irreversible, not because of tariffs, because the conflict had stopped being about trade. It had become a test of leverage, institutional credibility, and political endurance between two fundamentally different systems of power. One side believed pressure created submission. The other believed patience created advantage. And markets were beginning to choose which system they trusted more. The problem was larger than the deal itself. The problem was what the negotiation revealed. For nearly a year, Washington had treated the trade confrontation as a tactical pressure campaign. Tariffs on industrial steel, tariffs on aluminum, regulatory threats against automotive supply chains, public attacks against Canadian dairy protections, threats surrounding energy exports. Behind every move was the same assumption. Canada, economically smaller and deeply connected to U.S. markets, would eventually fold under pressure. Historically, that assumption had not been irrational. Roughly 75% of Canadian exports moved into the American market. More than 2.5 billion in goods crossed the border every single day. Ontario manufacturing plants relied on integrated supply chain architecture tied directly to Michigan and Ohio. Alberta energy infrastructure remained heavily dependent on U.S. refining systems. In purely numerical terms, the imbalance looked overwhelming, but geopolitical leverage is not always measured by size. Sometimes it is measured by dependency, and dependency cuts both ways. Inside the White House, advisors had reportedly expected early retaliation from Ottawa to remain symbolic. Temporary tariffs, carefully managed diplomacy, limited escalation designed primarily for domestic political optics. Instead, Canadian officials responded with something far more dangerous: institutional discipline. No emotional speeches, no dramatic threats, no theatrical press conferences. Prime Minister Mark Carney appeared publicly calm, almost to the point of discomfort. He rarely raised his voice. He avoided direct personal confrontation. He spoke in the language of sovereign credibility, long-term investment stability, and bilateral framework integrity. And that language began resonating internationally, especially inside markets, because investors were no longer simply analyzing tariffs. They were analyzing governance risk. Markets can survive conflict. They rarely survive unpredictability, and unpredictability had become the defining feature of the American position. By late spring, insurance costs tied to cross-border manufacturing contracts had risen sharply. Automotive suppliers in Windsor and Detroit began quietly restructuring logistics networks. Pension funds in Singapore and Norway started reevaluating long-term North American exposure. Trade negotiators from Germany and South Korea requested internal assessments regarding possible secondary supply chain disruptions if escalation continued into the following fiscal year. The trade war was no longer regional. It was becoming systemic. Then came the energy briefings, and that was when the atmosphere inside Washington reportedly changed. Because buried beneath the tariff headlines was a structural vulnerability American officials had underestimated from the beginning. Electricity. Every single day, Canada exported enormous quantities of power into the United States. New York State, Michigan, Minnesota, New England, sections of the Pacific Northwest. Millions of American homes, businesses, factories, and municipal systems operated within an integrated continental energy structure, partially dependent on Canadian supply stability. For decades, that interconnectedness had been treated as evidence of alliance durability. Now, strategists were forced to consider another possibility: strategic dependency. One leaked policy assessment circulating among defense linked analysts reportedly described the situation with unusual bluntness. The United States possesses escalation dominance in headline economics. Canada possesses asymmetric leverage in operational systems. That distinction mattered a great deal, because modern economies are not held together by speeches. They are held together by infrastructure. And infrastructure does not respond emotionally, it responds mathematically. Quietly, Canadian provincial officials began reviewing contingency authorities surrounding cross-border electricity agreements. Nothing public, nothing official, but enough to trigger concern among American energy regulators monitoring regional grid exposure. At almost the exact same moment, President Donald Trump intensified public rhetoric. The contrast became impossible to ignore. Trump approached negotiations like a pressure campaign built around dominant signaling, public statements, direct attacks, escalatory language, maximum visibility. The strategy relied on forcing rapid concessions through political discomfort and economic fear. Carney approached the conflict differently. He reduced visibility, he slowed tempo, he expanded institutional coordination. One strategy was designed for headlines, the other was designed for endurance, and endurance was becoming the decisive variable. Inside financial institutions, analysts began comparing the confrontation to historical currency crises, where governments underestimated the psychological behavior of markets during prolonged uncertainty. The issue was no longer whether tariffs would damage growth. That was already assumed. The deeper concern was whether institutional trust between two of the world's largest integrated economies was beginning to fracture permanently. Institutional trust takes decades to build and minutes to damage. By midsummer, sovereign wealth funds in the Gulf were reportedly reducing exposure to several North American industrial sectors tied heavily to bilateral trade stability. European ministries quietly accelerated diversification discussions surrounding strategic mineral sourcing. Asian manufacturers began exploring alternative routing through Mexico and Southeast Asia, not because collapse was imminent, because sophisticated systems prepare before instability becomes visible. Then came the first real sign Washington wanted out, not publicly, privately. According to multiple diplomatic sources later referenced by market strategists, American officials approached Canadian counterparts through secondary negotiation channels rather than formal presidential announcements. The tone shifted noticeably. Language surrounding mutual solutions replaced earlier threats. Trade representatives began emphasizing stabilization. Several proposed tariff escalations quietly disappeared from internal schedules. But Ottawa did not immediately respond. That silence lasted 48 hours. And those 48 hours changed the negotiation permanently, because markets understood the implication immediately. Canada believed time favored Canada. Currency traders reacted first, then bond markets, then energy equities. Analysts who had spent months assuming Ottawa would eventually seek rapid de-escalation suddenly began revising models entirely. If Canada was refusing a quiet exit ramp, then officials in Ottawa likely believed Washington needed resolution more urgently than previously understood. That realization triggered repricing across multiple sectors simultaneously. The Dow fell sharply during afternoon trading before partially recovering. Manufacturing indexes weakened. Transportation stocks showed unusual volatility. Energy markets became unstable. One investment strategist appearing on Bloomberg described the situation carefully but directly. This no longer resembles a standard tariff dispute. This resembles strategic recalibration between allied systems. Those words mattered, because allied systems are not supposed to behave this way. Behind closed doors, pressure intensified on both governments. American CEOs warned of supply chain fragmentation. Canadian export industries feared long-term structural damage. Defense officials privately worried economic hostility could begin contaminating security coordination across NORAD-linked planning frameworks. But the political psychology driving the crisis had already evolved beyond economics alone. Power often mistakes size for durability. Washington still possessed overwhelming economic scale. Nobody disputed that. But scale without predictability creates hesitation, and hesitation inside integrated systems becomes expensive very quickly. Meanwhile, Carney's government continued projecting disciplined restraint, no triumphalism, no public humiliation, no emotional escalation. That restraint itself became strategic leverage because every aggressive public statement coming from Washington increased the contrast, and markets noticed contrast. One side appeared reactive, the other appeared institutionally composed. In London, several foreign policy journals began discussing whether Canada was quietly redefining middle power diplomacy for an era of unstable superpower behavior. European officials reportedly viewed Ottawa's response with increasing respect, particularly among governments already anxious about long-term reliability inside Western alliance structures. The issue was becoming philosophical. Could advanced democracies still coordinate strategically if domestic political volatility overwhelmed institutional continuity? Markets were beginning to ask the same question. Then came the leak. Late one evening, details emerged suggesting the White House had explored temporary suspension mechanisms for several tariff categories without demanding immediate Canadian concessions in return. The proposal was never officially confirmed, but confirmation no longer mattered. The perception alone detonated across political and financial circles because perception drives markets faster than facts. In Toronto, advisors reportedly gathered inside the finance ministry until nearly 2 a.m., studying possible scenarios. In Washington, cable networks immediately framed the development as either strategic flexibility or political retreat, depending on ideological alignment. But international investors interpreted it differently. They interpreted it as bargaining asymmetry, and asymmetry changes negotiations. What happened next stunned even experienced diplomats. Canada refused to publicly validate the American off-ramp. No celebratory joint statement, no coordinated de-escalation announcement, no political rescue, just silence. Calm, measured, disciplined silence. The message underneath became unmistakable. If the United States wanted stability restored, the terms would no longer be dictated unilaterally. That realization reportedly triggered fury among several senior political figures inside Washington. Meetings became tense. Advisors exchanged blame. Trade hardliners argued escalation remained necessary to preserve presidential authority. Others warned additional pressure risked deepening investor anxiety and damaging broader strategic credibility globally, because the trade war was now colliding with another problem: debt markets. Foreign creditors had already begun quietly monitoring American fiscal instability tied to rising deficits, elevated rates, and growing political unpredictability. Extended trade disruption threatened to compound those concerns precisely when Treasury financing needs remained historically high. Economic systems run on confidence, and confidence is fragile. Several central banks reportedly increased internal monitoring surrounding dollar liquidity exposure scenarios tied to prolonged geopolitical trade fragmentation. Publicly, officials remained calm. Privately, concern was spreading, especially among allies. In Berlin, foreign ministry officials worried escalating North American instability could weaken broader Western economic coordination against China. In Tokyo, trade strategists feared retaliatory precedent might normalize weaponized tariffs between allies. In Paris, advisors reportedly questioned whether the United States was entering a period where domestic political impulses increasingly overrode institutional strategic planning. The damage was becoming reputational, and reputational damage compounds slowly before arriving all at once. Meanwhile, Canadian officials continued leveraging the most powerful weapon available during systemic uncertainty: predictability. Markets trusted consistency more than rhetoric. Every calm Carney appearance reinforced that contrast. His language remained technical, controlled, financially literate. He discussed investment certainty, sovereign reliability, infrastructure resilience, and institutional continuity rather than personal confrontation. The effect was subtle, but devastating, because sophisticated capital tends to flow toward environments perceived as governed rather than improvised. Then autumn arrived, and with it came the manufacturing data. Cross-border industrial activity slowed more sharply than expected. Shipping volumes weakened. Logistics costs rose. Several multinational firms delayed investment decisions tied to North American expansion projects worth billions collectively. Insurance markets repriced exposure across transportation corridors linked to ongoing tariff instability. One executive from a major automotive supplier described the atmosphere privately in unusually blunt terms. We stopped planning for policy. We started planning for volatility. That sentence terrified investors. Because volatility spreads, trade wars are expensive. Ego-driven trade wars become historic. Inside Ottawa, officials increasingly believed the strategic balance had shifted permanently. Canada had survived the pressure phase. International sympathy had gradually tilted toward institutional restraint over confrontation. Markets had begun rewarding predictability instead of aggression. Most importantly, Washington had blinked first, quietly. But everyone serious understood it happened. And once markets perceive hesitation inside a pressure strategy, recovering leverage becomes extraordinarily difficult. Late one night, after another round of stalled discussions, motorcades reportedly departed separate diplomatic entrances in Washington less than 4 minutes apart. One convoy accelerated aggressively into wet traffic under flashing lights. The other moved slowly, no sirens, no urgency visible from the outside. Inside global markets, however, urgency was everywhere. Asian trading desks opened to heavy analysis regarding future North American economic alignment. Commodity strategists reassessed energy corridor exposure. Currency traders debated whether the Canadian dollar had become temporarily undervalued relative to improving sovereign perception metrics. Something larger was happening beneath the surface. The trade war had exposed an uncomfortable reality about 21st century power. Large economies can coerce smaller economies, but interconnected economies can also constrain larger ones. That distinction may define the next era of geopolitical competition, because leverage no longer belongs exclusively to the largest actor in the room. It belongs to whoever understands systemic dependency more clearly, and Carney appeared to understand it extremely well, not emotionally, structurally. That difference shaped the entire conflict. Trump viewed pressure as a means of demonstrating dominance. Carney treated pressure as something to absorb, redirect, and outlast institutionally. One side escalated visibly. The other accumulated leverage quietly inside systems, alliances, markets, and investor psychology. By winter, many officials privately admitted the original objectives of the trade confrontation had become blurred beyond recognition. What began as tariff negotiation evolved into a global referendum on institutional reliability among allied democracies. And the world had been watching carefully, especially China, especially Russia, especially international investors searching for signs of Western fragmentation, because geopolitical rivals study not only military power, but alliance cohesion. And this crisis revealed cracks, not catastrophic cracks, but visible ones, enough to alter calculations, enough to trigger recalibration, enough to force allies into contingency planning they never expected to consider. The final irony was impossible to ignore. The United States entered the conflict believing economic size guaranteed negotiating superiority. Yet the longer the standoff continued, the more the conflict rewarded patience, predictability, and institutional credibility instead. Leverage cuts both ways, and sometimes the side appearing smaller on paper understands endurance better than the side accustomed to imposing pressure. In the final weeks before partial stabilization talks resumed, one senior European diplomat reportedly summarized the entire confrontation during a private dinner discussion in Brussels. This stopped being about tariffs months ago. It became about whether modern power still understands restraint. That observation lingered long after negotiations slowed. Because restraint is difficult in democratic politics. It feels passive, slow, unsatisfying. But markets often interpret restraint differently, as competence, as discipline, as survivability. The most sophisticated investors in the world rarely chase the loudest room. They search for the most stable one. And during this confrontation, stability itself became geopolitical currency. Historians may eventually describe the trade war as a transitional moment inside the Western alliance system, not a collapse, not a rupture, but a warning. A warning that economic coercion between deeply integrated allies carries consequences extending far beyond tariffs themselves. A warning that global markets increasingly reward institutional maturity over political theatrics. A warning that modern power depends less on domination alone and more on maintaining trust inside fragile, interconnected systems. Because once trust begins eroding, allies start hedging, investors start repositioning, supply chains start relocating, and history starts moving quietly beneath the surface before most citizens realize anything has changed at all. In the end, the most important moment of the entire crisis was not the first tariff announcement, not the angry speeches, not the televised confrontations. It was the quiet request to end the trade war without spectacle, and Canada's decision to refuse, calmly, without celebration, without emotional escalation, just disciplined strategic patience in front of a watching world. That was the moment the balance shifted. That was the moment markets understood the deeper reality beneath the headlines. And that was the moment global power itself seemed to change shape, if only slightly, in real time. Please hit the bell icon and subscribe my channel for daily updates.